Johnson & Johnson is near its 52-week low. We can see it is down 4% over the last 12 months. So is it undervalued? Should you be adding it to your portfolio? Today we are going to do a deep dive. As always, we're going to look at the top line revenue growth over the last 10 years. We're also going to look at the bottom line net income. We'll look at how much their cash versus their total debt, the health of this company, has improved over the last 10 years. We'll also take a look to see their total return versus competitors over the last 5 and 10 years versus some very strong competitors, in fact, in the industry. And as always, we're going to look at the institutional ownership. Are they buying? Are they selling? Or are they in fact just holding shares at the moment? And we'll see what are the insiders doing. We do note quite a significant amount of insider selling, so we will touch upon that. We're going to take a look as well at some news about an acquisition that they have made. In fact, just today this news has been released. And as always, we're going to look at the dividend safety. We're going to run through some very important financial metrics. And ultimately, we want to understand, bait it through our stock valuation model, what is the intrinsic value, what is the acceptable buy price given our investor margin of safety, and we'll look towards Wall Street to see what they're forecasting over the next 12 months. So let's jump straight into the historical performance of Johnson & Johnson. They are down 4% over the last 12 months, and over the last 10 years, we can see they are up only 57%. Now, this doesn't include those dividends reinvested, but that is a very poor return on any investment over the period. And we can see right now they offer a forward yield of 3.12% and a forward P sitting at just above 14. Now, when we do take a look at Seeking Alpha Analyst and Wall Street, they do believe that this is a buy right now. As we can see, these numbers are showing some strength. Now, let's do our own deep dive and understand in terms of the revenues. What we want to see over the last 10 years is realistically 3 to 7% growth year on year. Now, what we understand, December 2014, 10 years ago, they reported 74 billion on their top line. When we take a look at their most recent annual report, 85 billion. Now, there hasn't been that much growth, and when we do look at it on the granular level, we do see year on year there aren't increases, so it is very inconsistent. We do note when looking at this graph, some years it does increase, some years it decreases, so you're not getting a lot of consistency with this company. Now, we will look shortly at the percentage movement over the last 10 years to really understand that, but we can straight away see that their top line growth isn't showing signs of very strong increases in the right direction. Bottom line, a little bit of a different story. Now, their bottom line has gone from 16 billion all the way to 35 billion over the last 10 years. Now, that is very strong. It has more than doubled, but again, we can see the inconsistencies year on year. In fact, we see periods where it does drop and then it rebounds back up, stays flat. And when we do look at it, we can clearly see this isn't a company that has a lot of consistency, both on the top line and the bottom line, something we do need to factor into our margin of safety that we will look at shortly. In terms of the health of the company, total cash versus total debt, it goes from 33 billion in 2014 to around 23 in their latest quarterly report. So we can see, even though they do hold a strong amount of cash at December 2023, this has come down from 2014, 10 years ago. And we can see here the trend seems to be downwards over the long period. Now, not necessarily a red flag indicator, just something to note. And what is more important is to understand how that has affected the total debt numerically and directionally. Well, we can see, in fact, it's gone the way we don't want it to go. It's gone up from 19 billion in 2014 up to around 30 billion, 30 and a half over the more recent quarter. So whilst cash is going down, total debt is going up. Something just to consider, the trend with this total debt is going in the wrong direction, especially when we factor into the fact that cash has been coming down. Now, we will take this into when we look at the financial metrics, but just something to consider. Now, we're looking at competitors in a similar industry in the pharmaceuticals. We have Merck & Co., AstraZeneca, Roche Holding, Pfizer, Bristol Myers, a lot of reputable companies that we do like and have reviewed on the channel. Now, over the last 12 months, Johnson & Johnson is down 1%, but it is interesting to note that the whole industry has been very poor. The only one which is up, as we can see here, Merck & Co., 20.3%. But again, do remember that past performance isn't necessarily an indicator for future performance. When we extend it to the last 5 years, we do see Johnson & Johnson. Now remember, this is total return, so includes dividends reinvested, is in one of the middle performers, but still very poor return if you've been holding for 20 or in fact 5 years for 28% growth. And when we extend that to the last 10 years, we do see 106%, not really anything that we would say is impressive, and is one of the middle performing. So a lot of average statistics that I would say, in my opinion, with this company over the last 5 to 10 years. But let's keep going through and see if there is value that we can identify. Institutional ownership sitting around 69.5%. We do note 26 billion worth of sales by the institutions over the last 12 months. Interestingly, near enough the same amount of buys that we note in the same time period. So we can see here Johnson & Johnson, the same amount of buys as sales with institutions. No real essential reason that we can say if institutions do like or don't like. But what we do know in Q3, a lot more selling than buying. Q4, a lot more buying than selling. In Q1, whilst we don't have the full set of data yet, we do note a little bit more buying. So what we would say, overall, institutions are really looking at this as a whole. They've bought the same amount that they have sold. So quite interesting. And again, we'll consider that as we go along. In terms of insiders, now they hold 0.16%, so not a lot, but interesting to note, 17.31 million worth of sales by these institutions, with the largest and notable being Q1 of 2024, so literally the latest quarter of 9 million sales. So let's understand where exactly this is coming from. And what we can note, the largest one is from Jennifer T, the EVP, and we note the 9th of February sold just under 60,000 shares of over $9 million. Now, what we would say, it isn't, again, as we like to repeat on this channel, do remember that insider selling isn't a bearish signal the same way we see insider buying as a bullish signal, but it is important to note when insiders do sell. Remember, they can sell for personal reasons or financial reasons, but we do like to be transparent. We also note, whilst not insiders, but we do see members of Congress selling a fair amount over the last few months as well, as you can see. Now, in terms of looking at the news that we just wanted to bring to your attention today, as it is very fresh, so the Shockwave Medical Lands was been bought by Johnson, or has in fact been bought by Johnson & Johnson for around 13.1 billion. For those that are interested in what they do, they essentially, as we can see here, perform intravascular lithotripsy. Now, this breaks up calcium deposits in arteries with sound waves, something very similar to how they have been treating kidney stones over the last 30 years. Now, interesting to note from this news, when we do take a look at the share price, no real movement to Johnson & Johnson's current trading value. So it wasn't something that the market was very surprised about, or something that has sent the share price up. So quite interesting to note. Now, in terms of our newsletter, we have literally just an hour ago released our latest free weekly article. We run through some very nice undervalued dividend stocks. If you want to gain access, all completely free, whether it's this article or any of the others that we have released over the last few months, click on that pinned comment below and you can gain instant access. Now, in terms of dividend safety score, we have a 99, very safe score, the highest score obtainable. Market cap 367 billion. It is a large, or in fact a mega cap company. In terms of looking at the key metrics from the last recession, well, they increased the dividend. They had above average growth, -6, that was above the S&P's -12, and they also did outperform -27% recession return, with the S&P coming in at -55. Now, dividend growth, nothing too great. Let's be honest, the forward yield is around 3% consistently for a large portion of time. They did increase it last April, slightly above that inflation target we have of 4%. Do bear in mind, though, 4% was the US inflation rate on average over the last 40 years. So if you are getting less than that, whether it's your income, whether that's your other income producing assets or your salary or dividends, you are losing your purchasing power and taking a pay cut. At least over the last 5 years and last 20 years, we are seeing a higher dividend increase. And this does signal that this April, so literally this month, we are expecting another increase to Johnson & Johnson's dividend. Now, they are a dividend king. They have been increasing those dividends for 50 years or more. And we also know they have been paying a dividend, in fact, for the last 108 years without a reduction. Now, in terms of dividend yield theory, for those that are new, it states a company is undervalued when the current yield sits above the 5-year average. This is our first sign of undervaluation. We have another sign here with the forward P sitting below the 5-year average. And we also note it does sit below the healthcare sector P of 16.4. But one thing to consider is we're not looking at any of these individual models in isolation, and we will conclude when we review the valuation shortly. Free cash flow, as always, this is what we go to. Earnings is susceptible to manipulation by management through their accounting, and a blanket rule of 60% or more is my personal way to go. Gives me faith that they can get those double-digit increases that we do love to see. Now with Johnson & Johnson, it has been increasing over the last 10 years, still very healthy at 67% in 2023. Yes, it is expected to come down in 2024, which would like to give me faith that we can see a nice high single-digit dividend increase this month. Now, in terms of the free cash flow per share, we do know increasing free cash flow over the longer term, but again, bear in mind the type of company that we are looking at. This isn't a fast-growing tech company. It is more of a mature company, so the growth will be very minimal year on year, as we can see. 2024, we are expecting, however, a nice increase to around $9.40. Sales growth, well, as we mentioned earlier, not the largest growth as we went through the last 10 years. We can see around 6% in the more recent period, which is nice considering our baseline of 3 to 7%, but we do know when we go further back, they have really struggled to really get to that, so do consider that. And when we look at their total sales, if you were to factor in inflation at 4% year on year, they probably wouldn't be increasing that top line in real terms. What they do, which is nice, by essentially returning excess cash to investor pockets, is share buybacks, increasing your position or ownership of the business, reducing the shares outstanding from 2.86 billion to 2.56. Now, when we take a look at the ROIC, we do know very strong, very healthy. I want to see above 10%. Different people will have different targets. Double digits, very strong, very consistently, 23% in 2023, very attractive for investors, essentially showing that management are able to effectively allocate their capital. Operating margin, well above the minimum of 12%, free cash flow well above the minimum of 5%. So this is a very strong company. It is very consistent. The real question is there any value in this company that has really struggled over the last 10 years in terms of a strong total return performance? Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, we want to see below 3 for the majority of companies, essentially giving us faith in the balance sheet strength, and this also correlates to dividend safety. Now, these are the number of years it would take the company to pay off all of their debt net of cash on hand. 0.25 in 2023, 0.23 in 2024, very, very strong. In fact, they have one of the best graded balance sheets alongside Microsoft, so there are no real worries with their balance sheet. The only thing we would say that we did when we looked and ran through their essential balance sheet was total debt was increasing over the longer term. Whilst remember, when we did take a look at their total cash, whilst it was very, very nice, it was decreasing from 33 billion to 23 billion in the latest quarter. Something to consider, but let's now jump into the valuation model. If you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model that we're jumping into, it is the multiples valuation model. Companies in a similar sector and size that we analyzed, as we can see, we have the average P multiplied by the EPS of Johnson & Johnson to get an intrinsic value showing signs of undervaluation on this first model. Do bear in mind, again, we don't look at any of these models in isolation. We then have the dividend discount model where we have the yearly dividends with the average growth rate of 5.75. We've gone a bit more conservative at 5.25, and we do see our intrinsic value here coming, showing another undervaluation signal at 182. We then move on to the third model, the discounted cash flow model with the free cash flows year on year. Average growth rate pretty much flat. We've gone for around 6%, slightly lower than analyst and management targets to be a bit more conservative. With a discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get to an intrinsic value. Again, pretty much showing a very similar value than all of the models. So today's intrinsic value is the average of these three, which is quite nice to see when they are roughly the same. Does give me faith in the intrinsic value calculation, and it comes to $185. Now, do bear in mind you can grab a copy of the valuation model by clicking on the pinned comment below, so you can get to your own intrinsic value and acceptable buy price of companies in your own portfolio or those in your watch list. As always, we start off with 10% margin of safety. We use this as a trigger to buy stocks if we believe it meets the three criteria: wide moat, strong financial metrics, good forward-looking data, and then we keep going till it's near the current trading price. Different investors will have different levels of margin of safety. So it isn't quite at a 20% MOS level just yet. Based on 15% though, around 15 to 20 currently, it is a buy up to $157. In terms of Wall Street, now their forecast is $179. They see upside of 17% over the next 12 months. They do believe this is a strong buy now, similar to when we did run through and looked at the beginning in terms of Seeking Alpha as well as Wall Street analysts both calling this a buy. Now, my opinion, this is a stock that I do hold. However, right now, even though Wall Street are forecasting strong upside, even though we do see a 15 to 20% MOS level, this isn't one that I'm looking to add to my additional amount in the portfolio. When we do take a look at the historical performance, we do see some very mediocre performance, total returns. And in the future, I don't see Johnson & Johnson outperforming the S&P 500 right now. The only way that I personally would be adding this back into or in fact increasing the position in the portfolio, was if we would see this very discounted, maybe 25% around the $138, $140 mark. Right now, at a 15 to 20% MOS level, I do believe there are better options out there. However, I'm interested to hear your thoughts. Let me know, is Johnson & Johnson one you are adding to? Are you similar like me, just holding your position? Or are you considering selling? As always, though, if you did enjoy the episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.